Two people, both 35, same city, same health, no medical history between them, and both want the same health cover for their family. One pays about 15,000 rupees a year, the other pays about 35. Same everything and a 20,000 rupee gap every single year. Neither of them is being cheated, neither got a special discount. That gap isn't luck, and it isn't the brand they picked. The second person made one decision that felt like the most loving thing they could possibly do. And it more than doubled their premium. Here's what nobody tells you about health insurance in India. Most of your premium is set by 4 forces and you control almost none of them. 1. Medical inflation. Running at roughly 12 to 14% a year, look at the figures on screen. A procedure that cost 3 lakh rupees in 2021 costs between 5.3 and 5.8 lakh today. It crosses 5 lakh at either end of that range. Inflation सिर्फ सब्जी और पेट्रोल में नहीं होती. 2. Age bands. Pricing moves in slabs, not smooth curves. So one birthday can tip you into an entirely new bracket and the number jumps hard. 3. The pool. You aren't priced only on you. You're priced alongside everyone else who bought the same product. If their claims run hotter than the insurer expected, your renewal goes up. You did nothing. 4. Your PIN code. That same 35-year-old buying 5 lakh of cover pays around 8,400 a year in a metro and about 5,950 in a tier 3 town. 41% more for identical cover. Inflation, your age, the pool, your city, you get a vote on none of it. So फिर बचेगा क्या? This. The part that separates 15,000 from 35 is structure. How the policy is actually put together, and structure is completely, entirely yours. Welcome to Insurance Academy by Acko. 4 structural moves today and 1 promise before we start. I'm not going to tell you to buy a smaller cover. Buying less protection isn't saving money. It's carrying more risk quietly and hoping nobody notices. Every move here keeps your protection intact or improves it. We are changing the shape of the policy, not shrinking it. Don't chase the lowest premium, chase the best structure. 4 moves laid out here. Then a warning about the traps that make a cheap premium expensive later, and a checklist you can run on your own policy tonight. Move 1. This is the one that costs Indian families the most money because it's the one that feels the most right. This is the big one. It's also the reason our second buyer was paying 35,000 instead of 15. Most Indian families do the same thing. One family floater. You, your spouse, the kids and your parents all on one plan. It feels simple, it feels tidy, and honestly it feels right, like you're taking care of everybody under one roof. Here's the problem. A family floater is priced heavily on the eldest member of that policy, not the average age, the oldest person on it. So a young couple with one child might get a floater for around 12 to 15,000 a year. Add one 60-year-old parent to that same policy and it can climb to 25,000, 35,000, sometimes more. And notice what actually happened. You barely added any cover. You changed who the policy is being priced for. And the pricing isn't even the worst part. A floater is one shared pot of money. Say your family floater is 10 lakh. Your father has a hospitalization in March and it uses 6 lakh. The policy has done its job exactly as designed. But watch what happens to the rest of that year. Look at the bar on screen. 10 lakh minus 6 leaves 4. And that 4 lakh is now the total cover for the entire family until renewal. Your spouse, your child and you all sharing what's left. So the structure hurts you twice. It prices the young members of your family like senior citizens and it lets a single claim thin out everybody's cover at once. The fix is unglamorous and it works. Give your parents their own separate policy. Their risk profile is genuinely different, so let it be priced on its own instead of dragging your whole family's premium up with it. Go into it clear-eyed. Senior plans do cost more and the terms are stricter, but you pay that price once on one policy instead of letting it quietly set the price of your entire family's cover. Move 2. It is the one people discover about 5 years too late. When someone wants serious cover, say 50 lakh, the instinct is to buy one big 50 lakh base policy. That's genuinely expensive because the insurer is pricing full risk from rupee 1 all the way up. There's a cheaper shape for the same protection and both options are on screen. On the left, 150 lakh base policy. On the right, a smaller base plan of 5 to 10 lakh with a super top-up of 50 lakh or a crore sitting above it. The base handles ordinary hospitalizations. The super top-up handles the genuine financial shock. And because the top-up only starts working above a threshold, it costs far less per rupee of cover than buying it all in one block. Now, one distinction decides whether this actually protects you. It's also why I want you to say the words super top-up specifically and not just top-up. A plain top-up applies its threshold to a single claim. A super top-up applies that threshold to your total claims across the whole year. That one word is the entire difference and it's on the screen now. Watch what that does. You have a 5 lakh base plan with a 5 lakh threshold. This year, you have 2 hospitalizations. One costs 3 lakh, the other costs 4. 7 lakh in total. With a plain top-up, look at each claim on its own. 3 lakh doesn't cross the 5 lakh threshold and 4 lakh doesn't cross it either. So it may never trigger at all despite you spending 7 lakh. With a super top-up, the 2 claims stack. Your yearly total is 7 lakh. It crosses the threshold and the excess above it gets covered. And that matters because real life rarely sends one clean, enormous hospital bill. It sends a child's admission in June and a parent's procedure in November. The super top-up is built for exactly that. The plain top-up often isn't. Sometimes the premium is still higher than you want and an agent will offer a way to bring it down. Carry part of the cost yourself. Fair trade, but how you carry it changes everything. A copay means you pay a fixed percentage of every claim forever. A deductible means you pay a fixed amount first and the insurer takes over from there. That sounds like a technicality. It absolutely is not. Let's do the math once. Follow the 2 columns on screen. Take the copay column first. With a 20% copay, a 5 lakh bill costs you 1 lakh, a 10 lakh bill costs you 2 lakh, a 15 lakh bill costs you 3. Your share climbs as the bill climbs, which is precisely backwards because the worst medical events are the expensive ones. Now the deductible column. With a 50,000 aggregate deductible, you handle the first 50,000 of your medical costs for the year and the policy takes over. 5 lakh, 10 lakh, 15 lakh, your share stays 50,000 all the way down. It doesn't move. Both will lower your premium, only one caps your worst case. So if you're offered this choice, know which one you're taking. Move 4 is 2 habits that quietly save money every year. First, audit your riders. Some add-ons genuinely earn their place. Many don't. They were attached at the point of sale. They sounded impressive and you have paid for them every year since without once using them. Open your policy, schedule and ask a blunt question about each one. If I actually needed this, would I claim it? Anything you can't answer confidently is a candidate to drop. Second, remember you're allowed to leave. Portability exists. If your structure is genuinely wrong, parents stuck on your floater, a copay you regret, a policy repriced past what it's worth to you, you're not married to that insurer. And 2 rule changes from 2024 made leaving far less scary. Both on screen now. Pre-existing disease waiting periods are capped at a maximum of 3 years, down from the 4 that used to be common. And the moratorium period is now 5 years of continuous renewals, after which the insurer's room to reopen old, non-fraudulent disclosure issues is much smaller. Portability can also carry your accumulated waiting period credit across. Though timing rules apply and the new insurer terms still matter, so start the conversation well before your renewal date, not in the week of it. But let me be very clear about one thing, because it's the most important sentence in this video. None of this makes disclosure optional. Chupaoge to fasoge. If you have BP, thyroid, diabetes, anything ongoing, declare it properly. Saving a little premium by hiding a detail is the worst trade in this entire video. One warning before the checklist. Everything so far is about paying less, and some policies are cheap for reasons that cost you badly later. A high premium hurts today. A badly built policy hurts at the hospital counter, which is a much worse day to find out. Premium mein thodi bachat, claim mein bada nuksan. So before you accept any cheaper quote, check the 3 things on screen. Room rent limits, disease-wise sublimits, and when your restoration benefit actually triggers. For reference, our own Platinum plan is written without a room rent cap, without disease-wise sublimits, and without copay. That's the wording you're checking for, whoever you end up buying from. We took all three of those apart properly in another video on this channel. It's linked above, and if a quote looks unusually cheap, that's where you should go next. So here's the whole thing in the order you should run it. 1. Are your parents on your floater? If they are, price them separately. 2. Is your cover sitting in one big base policy? Try a smaller base plus a super top-up. 3. Are you carrying a copay? Check whether a deductible fits you better. 4. What riders are you paying for every year and never using? Drop them. And 5. Room rent, sublimits, and the restoration trigger. Do you know all three on your current policy? If you don't, that's tonight's homework. And run it tonight, not at renewal. Renewal is when you're rushed and the number is already sitting on the screen in front of you. That's the worst possible moment to think clearly about structure. Because the honest summary is this: health insurance is expensive and getting more so, and you cannot argue with medical inflation. But a very large number of Indian families are paying a premium set by a structure nobody ever sat down and chose. It just accumulated, a parent added here, a rider attached there, one big base policy bought years ago because it sounded safest. That full checklist is in the description as a downloadable sheet, so you can go through your own policy line by line rather than from memory. This is Insurance Academy by Acko. We make health, car, bike, and term insurance. And on the one force you genuinely can't control, medical inflation. Our Platinum plan adds 10% to your sum insured every year, claim or no claim. But we'd make this video either way because a country that understands its own policies argues with its insurers a lot less. Subscribe if that's useful to you.